Good morning, everybody. Welcome to Wise Tech for Wise Money, the podcast where we speak with founders, operators, and investors about how technology strategy and real world execution come together to build stronger businesses. I'm Gary Wayne, founder of A1 Solutions, where we help companies grow intelligently through better strategy, better use of technology, and practical AI driven automation. Today's episode is titled The Financial Architecture of Scale, Why Most Growing Companies Break Before They Break Through. I'm joined today by Tim Danser, founder of Finity, where he works with high growth companies providing fractional CFO support combined with operational and systems implementation. This work goes beyond traditional finance. This is about building the underlying infrastructure of a business, the systems, visibility, the decision-making frameworks that ultimately determine whether a company scales efficiently or hits the ceiling. Well, I'm glad I got that out of my mouth. Welcome, Tim. It's good to have you on board.
It's good
I
to be
hope you've had
here.
a good day.
Yeah, great day. I'm excited for the conversation.
Cool. Maybe we can start by just a brief introduction, how you got to where you are, how you got to set up your own business, etc., etc.
Yeah. So I started my career in commercial and investment banking, and I really enjoyed doing transactional work. But one thing that I felt was missing is understanding strategy, building out companies more. So I made a pivot into a large multinational corporation. Then I went and got my MBA, and after business school, I joined a tiny little startup. And we eventually grew, got bought, and then that company got bought by Google. And through all those experiences, what I really kind of learned that I love is building companies and building a strategy with founders and really highly motivated folks and executing against it. A lot of wearing lots of hats and doing lots of things, that's what I enjoyed. And so each one of those was like a great experience to land me into where I am today and founding Finity.
And how long has Finity been going?
We were in stealth mode for a year and a half, and then we went live at about a year and a half ago. So I'd call it 3 years, but really publicly out there about a year.
How many of you, may I ask?
Sorry?
How many guys or how many people?
Yeah, so we have 6 folks on staff. And you know what's kind of interesting, Gary, is that what I've seen is it takes a broad array of different experiences to really kind of deliver something real. So the folks we tend to have are CPAs, ops, investment bankers, expertise in a lot of different variety of finance and accounting. And the reason for that is when you have those different experiences, it helps kind of round out all the little things that someone who can't afford a proper CFO or director of finance or VP of finance to deliver against. You know, it's hard to know what am I getting into with fundraising or raising debt, or how do I build out automated reporting? Those things, it takes a lot of different perspectives on how to execute.
Sounds like a solid team. Let's start with what you're seeing in the markets right now. When you step into a business for the first time, how often are you seeing real financial clarity versus educated guesswork?
Interesting question. Yeah, I think it's about 50 and 50. So, or maybe I'll go about it this way. It's about 40-40-20. And what I mean by that is the last 20 like really gets it and understand it. And what we often see is there's 40% of the time where folks are saying, I think I know. And as you start educating them more on what you can get, what can be there. And in that 40% too, some folks actually they do understand it. It's just a very manual, tedious, time-consuming process to get there. Then the last 40 goes, I know this is a problem. I know there's something better. I just don't know what to look for and how to do it.
Do you find that people are willing to take help? Are people asking for help? Are they looking for help? Do you have to find those people?
It's, again, in that blend, there are definitely folks that go, I know I need help, and please just help me. Those are great folks, lots of great across the spectrum of things, but there's folks that just know it. And then there's folks where you need to guide them through that journey with them, show them what they can do and what they can be. And it's up to them to decide whether they want to go there or not. And part of it is like, it's my job to educate and show people what it can be. At Startup World, you don't have unlimited resources. So you're somewhat constrained on your options. And so one thing, what's that?
No, go on, carry on.
So one thing is just educating and then letting people choose what they can and can't do based on what they have today. Because one thing we always try to make sure of is saying, well, this is kind of nice, but it's not necessary for your business. And so maybe you don't want the really high, flashy thing that does all the bells and whistles, because you need to focus on selling. You need to focus on building. And that's part of like how we guide folks around. And so while some people may say, I don't know, now I know, and I want that, is sometimes you kind of got to walk them back from perfection because it's the enemy of good enough.
But where do you think founders are underprepared financially as they scale? What's the most common problems that you find with regard to that?
I think there's a lot of folks that set up great product infrastructure. Two of the areas that we really kind of try and pull some emphasis on is building out a plan for the future, like a financial plan, that is. So saying, what headcount do you want to get? How do you want to scale your business? Where do you think things should go? Where do you think you're efficient with your resources? And how can we measure that efficiency? The other thing that we really kind of help on is guiding on the ops and particularly sales ops. And what I mean by that is figuring out the breakpoints of, you want to hit this much in new bookings. You have this much in existing business. There's this gap here. How do we solve for this gap? How do we build a commission plan to incentivize new account executives? What's the timelines to go out and get those folks? Those are kind of the two big pillars that we've really seen, is visibility into a plan and how much resources you have today and where you can go, as well as how to execute against that plan to fill the nuts and bolts to incentivize folks to learn and grow with the business.
How do you do that? When you're a startup, you don't have a lot of business, you haven't got a lot of money, you want to employ good people or bring good people on, but you just, you don't know which way to turn. And we've all been there because you just don't have the funds.
And what's funny is this going to be a interesting spot to start, but usually I think of it as a pyramid. You have to build something up to that scale. And what I mean by that is that the base of the pyramid, the foundation of everything, is usually at the books, which seems kind of silly. But the reason you start at the books is you want to know garbage in and garbage out. So one spot I usually start with founders is saying, what money is coming in the door? What money is going out the door? And then from there, kind of evolving that. So once I have the building blocks, I understand what money is being spent and what money is being generated historically. Then you can go to the next piece of that pyramid, which is financial planning and analysis. Taking in the headcount you have today, scheduling out what are your future renewals. What do you expect to spend on for insurance and buildings and accountants and lawyers and all those things? As we further go along, then you get to start layering in more of those pieces like, what headcount do I want to hire? And what do I think they can do? Why that's important is because then you start building commission plans around that. You have targets. You have all these inputs needed to really drive decision-making. So as we start going up that pyramid, then it becomes, here are the KPIs we want to start measuring. Here are the metrics and what is going to helpful and what's going to be helpful. What signals areas where we need to reshift priorities. So it's that constant building upon a base foundation of money in, money out, evolving it from there and understanding more and more of that picture.
I think, when I talk to someone like yourself, it all sounds quite easy. But a lot of entrepreneurs I come across, they want to be all things to all men. They've got this idea, they've got this plan, and they want to be able to hit the road delivering it all. How do you rein them in so that they focus on their strengths first before they start building out the edges?
Usually the way I've seen it happen is it's scenarios and testing and pulling. And that's where a great finance partner helps you, is saying, we can't do these things. My job is not here to tell you don't do it. My job is here to say, here is what those decisions mean. And here are all the little levers that you can pull. The reason that's important is because things like, let's say you want to structure a deal and you want to offer net 90 terms on that deal. Well, that's going to impact your cash flow. Those sensitivities and being able to pull them into a cohesive resource story is where we really shine. And so how we usually rein folks in is saying, here are all the decisions that you want to make, and here are the different things and outcomes that will come of it. We can plan around that, and let's try and make that work. And so that's usually how we help folks that want to do a lot, but then figure out, got it, this is what I can do.
Excellent. So when we think about a fractional CFO, etc., it can mean a lot of different things. When a client brings you in, what are they really getting? And are they getting what they expected?
Well, and to that point, there's a lot of different types of finance professionals. So we're talking fractional and outsource. And what I've also educated people on is that's not your only option. There's full-time, obviously, that's the traditional route. And then there's interim people, folks that will work for a certain period of time, full-time, and then they're gone, So lots of different types of things. And then when you do a double click into the fractional or outsource CFO, there's different levels of service. There's folks that say, we'll do the accounting, we'll do the books, we'll put DoorDash to meals and office supplies for Amazon and so on and so forth. As you go up that spectrum, there's folks that will do more and different things. And there's a whole slew of individuals and firms that do strategy, big picture, KPI measurement, long-term planning, and nuts and bolts keyboards. And so that's how I think of it, is there's a broad array of different choices out there, and you have to figure out which one's best for you.
If you're a CFO or a fractional CFO, do you have to be a CPA to do that?
Not in my opinion. I mean, there's lots of great folks that have different experiences. So for example, I'm a CFA charter holder and I have an MBA. Those are nice qualifiers. A CPA is a great qualifier as well. And part of when you go through your checklist of what are my needs, like what you should really look for is what business needs are you solving for? Are you a highly technical accounting business that needs a lot of expertise? Well, someone who has a CFA charter and MBA may not be as good as a CPA. But if you're trying to do long-term planning, growth drivers, valuation, eventually set up for a raise or a sale process, then a CPA may not be as traditionally trained as someone else who has those experiences. So it's a very case-by-case, business by business dependency.
So as a business, where do you set? Do you set direction? Are you involved in the detail and execution? At what point does a business go from we'll figure this out ourselves to we actually need someone like Tim involved?
It's funny is Gary, I've been in companies that pre-seed. I just got a term sheet. What do I do now? And that is like, you need the bank account set up, payroll, accounting, cap tables, all these things that go into setting up a business to post Series B. My investors are asking me 50 million things. I just need help and I'm buried. In my opinion, there's no wrong spot to start. So we've started at the low end of the spectrum. And it's not about necessarily when do you need it, because in my opinion, you're talking to someone who does this every day. In my opinion, you always need one. What I would also say is you need a partner who's open and willing to say, you don't need to meet with me every month. What you need is to manage your burn really low and just understand it. And that's what we'll help with. Versus someone who is a much bigger, more mature, maybe even a private equity backed business that's trying to eventually sell, is what is a much broader spectrum of things do you need done? Things like KPIs and OKRs and a long-term plan for 3 years with targets and metrics and execution and contracts and all that.
What I'd like to understand, not being a US person, is there's several structures obviously that you can set up a business as LLC, et cetera, et cetera. What are the different structures that are best suited for different types of businesses?
That is a very great and loaded question. So I would say, one, I'm not a lawyer, but I can make my observations known and all that. So the usual companies I deal with, they're trying to go out and either get acquired or raise or all of that. That usually lends itself to a C Corp or an S Corp. Why? The reason is you can distribute out shares and go for authorized shares and distribute out ownership of the business. Sole proprietors, single member LLCs, dual member LLCs tend to be fairly controlled with the ownership. You can't distribute ownership of the firm as well. So in my opinion, really, again, not a lawyer, but in my opinion, where your type of business setup really matters is based on the type of arrangement that you want to split ownership. If you want to control the whole thing in perpetuity, some ownership structures are much better than people that want to distribute ownership, go get fundraising, et cetera, et cetera.
Is there a structure that protects you more as a director or vice president or president or CFO or CEO? Is there a structure that's better for that type of, when you're looking to expand quickly?
I would say most of the corporate structures I've seen tend to protect the employees and directors pretty equally. Again, not a lawyer. But what I will say is there are a number of intricate ways you can push and pull different things to set up to protect yourself in a bigger picture. And Tim, what does that mean? Like, you're talking generalities. What I mean by that is some companies elect to do a C Corp that owns an LLC, that owns this, and then has multiple entities that does a lot of different things. So to make this very real, for example, some real estate companies say, I want to be a C Corp because I want to distribute my ownership. But I have these multi-family units, and each one of those I want to house the risk. So that way my business as a whole isn't exposed to the risk of each one of my buildings. So what some people will do is say, let me create a company, be it an LLC, a C Corp, an S Corp. Let me create a company for each one of my units. And that way the parent owns the subsidiary to say, I've got this big company over here that owns the small companies. And if one thing happens at that small company, it doesn't expose the risk to everyone else.
That's clever. So you made a point, I think, when we spoke about saying you are hands on the keyboards, which I think a lot of people wouldn't expect at your level. When you go into business, what are the first things you typically look to fix? Well, what are the most common breakdowns? Accounting systems, reporting, lack of integration between tools. How important is it getting tech stack and financial infrastructure right early? And I'm asking you a lot of questions. And what does a well-structured finance function actually look like in a scaling business?
We have, at Finity, we have 6 core pillars, and one of those is technology. And the other is being tailored. Why I bring that up is, in my personal opinion, each business is unique. Like there's no kind of cookie cutter way you can cut and slice and dice this. I bring that up because a Series A enterprise business should have a different tech stack than a rapidly growing Series D or bootstrap business that is selling high velocity stuff at low prices. And so, in my opinion, there's a lot of different flavors and ways you can do it. So, how I do believe things are usually done, and going back to the first part of your question, is it usually starts at that pyramid we talked about, the books. The books need to be clean and solid. What I find a lot of folks tend to not do is turn on all the embedded automation and reporting capabilities in their existing tools. One of our biggest things is unlocking value in your existing tech stack. We want to be surgical in adding things that are valuable. We don't want to say, these are the tools we work with no other tools. That's one of the reasons we evaluate lots of different things to say, this tool is great for you, this one is not great for you. And so deploying that tech stack, it takes a lot of meticulous time and effort and understanding all the intricacies, as well as the strategy that goes into it. So you say, hey, Tim, not a lot of people are hands-on keyboards at your level. I do understand that, and that's true. And it's one of the reasons I am still trying to be hands-on keyboard. I don't believe you can really guide people unless you know what pain points they face day in and day out. It's one of the reasons I love training my own folks, because I can show them shortcuts, paths to get things done better, quicker, faster, etc.
So, do you just concentrate on startups, or will you talk to any company that needs, your expertise?
It's an interesting question. We deal with lots of different spectrums. So we have some businesses that are $14 million in revenue, some that are in $30, $40 million in revenue, some that are making no revenue, and some that are founder-backed bootstrap businesses, private equity purchased, and they're trying to clean everything up, and then recent VC investments. It goes all into the spectrum for us. And what's really nice is the principles of finance and accounting hold true across every firm. What a really good financier and accountant knows is how those principles apply specifically to your business, and is willing to take the time and effort to understand your business to properly account and plan for it.
Well, what would you say the stages in what would you say are the most difficult stages in business growth?
There's a few, and it depends on how in my opinion, it's always hypergrowth. Hypergrowth is the hardest. If I had to, Tim, I need one, it would be that one. And the reason I say that is getting all the moving parts together of how do you create a scalable infrastructure that says, here is a new customer, here is the information that tells you whether you're being efficient with sales and marketing, and then here is the trigger point in which to go hire more, and how do you go hire more? That's a very intricate and complicated means to figure that information out. I'll also say one of the things that we help a lot with is how do we manage the downside? That's what your finance person should be saying to themselves every single day. I think I drive people nuts with that, is saying our job is to make sure that if you lose money, if you lose clients, if you lose customers, that you are protected to go long enough to figure this thing out. So it goes back to that whole theory of we're here to show you options. We're here to show you what you think the plan will be and what happens if you're wrong. And in my opinion, that is a good finance person, and a great one sets you up to say, here are the protections on how you can last longer if that does happen. I like to think that's where we play, coming up with a plan of here are the cost reduction efforts. Here's where you can go optimize on your inventory, on your cloud infrastructure, on getting external sources of capital. That's what I like to think we do.
So you're much more than a CFO. I mean, you are a total business advisor, really. What are the key metrics founders should really be paying attention to? The ones that actually drive decisions and make them successful. How do you move a business from reacting to what's already happened to what should be happening, and where do you most often see poor financial decisions being made?
It's a super awesome question. It's a great question. And it's specific to the situation. Let me talk a little bit about why though. Is a company that's bootstrapped or not looking for external financing ever, what I think matters to them is much different than someone who knows we're building a product, we're growing our business, and we eventually need those resources down the road to fuel the fire and grow the thing. So talking a little bit more specific about that, someone who's bootstrapped or fully owned or whatever structure you want to think of, they need to think through sales efficiency. What are the metrics to say our sellers are doing much better than we anticipated, and now it's just about taking money and putting it in. But it doesn't stop at the sellers. So it goes higher up the funnel. What dollars does it take to generate a lead? How long and how efficient are those leads? And then how am I closing out deals? That is one type of flow and KPI set versus someone who's saying, we need to measure how our growth is going because that's what investors are interested in. And as that growth is happening, are we being even better with our existing customer base and getting new customers, and that the growth is exponential coming than necessarily the other one? So I bring these theoreticals up to say there's a different set of indicators for different types of businesses. And that's also where we help guide founders saying, I think you may want to look at XYZ and not ABC.
You mentioned that you train your team to execute your framework. When if I come to you and say I need help, am I hiring Tim or am I hiring Tim and his team?
I would say, if you said, Tim, are we hiring you? You're hiring Finity. And why I think that's an advantage versus just one person. One person doesn't scale. And one person's expertise may not be right for that situation. So, of course, if folks say, am I working with you? Yes, you're working with me if that's the arrangement we've arranged. But I will tell you that there is someone else who can help you also with doing a deal run process. When you need more technical accounting memos done on rinse and repeat, that's someone else's skill set. And while I can certainly execute them, I lean on a team that knows how to do it at the same scale and speed. It's one of the reasons that I mentioned I like training people. I would say you brought up this word, which is a great one, is framework. I give them a framework, but I can't be expected to know everything. It's kind of like an Ender's Game where he goes, I can't have all the solutions. So I give people guidance and ways in which they can attack a problem. But everyone on the team is more than capable of saying, this is a better way than what Tim has suggested. And by the way, I like my team members contradicting me and giving me their opinions on calls with clients. So a client knows 2-3 different ways to approach the same problem. I think that's valuable. And having a bunch of yes people is not a great answer. Having a bunch of people giving their perspective and opinion and coming with a cohesive recommendation, that's what I like to do.
So how do you create consistency and quality? And also, if you've given me 3 or 4 options, Actually, how do I decide which option to go for?
I would say, Lance, so Tim, I have X, Y, and Z needs. So start of it is starting off on your own needs. What do you need? Like, do you need accounting and banking and this and that and this? Or do you need just, we get people that are going, I am buried in tasks. I want to engage your firm. I need help deploying tech stack, managing bills, sending customer invoices out. Well, you don't want someone at the CFO level doing that. That's way too expensive. You want someone who's much more efficient and cost affordable. But also, it's kind of nice having that ability to say, now I need this, and now I need to know how can I have a financial plan? I know there's a problem with payroll and integrations. How can I do that? So having your needs kind of listed out and us tailoring a solution around your needs, that's where we try and do our engagements.
So, thinking about what you're doing, it's a great service. I'm a company owner, and I've taken fractional support. And from what you're saying and from what I understand, it's all encompassing. How do I then go to a full-time CFO? It seems to me that if I go to a full-time CFO, while I'm getting a full-time partner or employee or however you want to picture it, I'm actually going to be limiting myself from what I've been experiencing using Finity.
Now, Gary, I believe that. and I believe that too, because in the sense of, what I'm trying to educate people on is the market knows fractional and outsourced CFOs. It's what they know. But there's a lot of other things that go into running a business. You need to set up payroll, offer benefits, do 401k planning, 409A compliance. There's tax return work. People sometimes face SOC audits. They need insurance. There's a lot of stuff that goes into setting up in the United States, knowing the difference between one type of payroll software and another type where you have to go register for every state, or you don't have to do any of that. Those things I'm trying to educate people on to say, there's the solution we offer, which is more fractional COO, folks that can help you end-to-end of the spectrum. And what I will say, though, is that I often talk to my clients to let them know there is a path to graduation. And let's be upfront about that. When it is more valuable to have someone else come in full-time and do this. So people ask me, like, wait, you're already trying to get off? Like, no, we're not trying to leave you. What we want to do is show you that there is a certain break point where your business starts to scale, where it's more cost-effective or better for you to have someone there permanently. Graduation for us looks like we go out and help hire them. And I've said this 2 or 3 times to clients that have graduated. I've helped hire a director of finance, VP of finance, whatever you want to call it, and said, I am your boss, but the expectation in 3 to 6 months is you will be my boss, and we will eventually transition off. And so one thing I really like making sure our clients understand is we maximize value for you. And we will let you know when your value is not being maximized with our service. So folks know up front that when they get us, they get the best. They're not getting a drain on their team.
But, I mean, your service is all encompassing. So, there could be certain businesses that, even though they want a full-time CFO, they want to keep their fractional COO, in the loop. Does that happen sometimes?
It does. And in fact, when we talk about that graduation path, it is not a 1-month transition usually. Usually
Sure.
It takes multiple months. And what's funny too is I have let folks know, your person who is using me and I'm engaged and I'm happy to meet with them, they don't need me anymore. And they'll keep us on for a few months just to have the safety net. Because what I like to tell people that we really offer is when you're a founder and then eventually graduate off, is what we help solve is not necessarily just financial planning and analysis or accounting or something like this. What we solve for is when you're a founder or a CEO or an executive, you are getting bombarded 50 trillion different ways. There's a legal issue that came up. Now I've got a payroll integration problem. My 401k provider is getting acquired and now they're switching on over. These things that come at you that are just blind sides, what we try and do is buffer that and say, you can be focused on your vision and selling your product and building your product or service. And what we offer you is peace of mind to run your business day to day so that if this thing comes up, we're there to help you. And eventually, if it comes to the point where you're ready to graduate off of us, we help that person who's there to help them understand.
It's superb. When you first step into a company, what do you normally find the major problems are? Is there a common denominator? A lack of visibility, poor systems, poor leadership, or leadership misalignment? Do you find that founders tend to underestimate the importance of finance, especially in the early days? I know you said, keep your books clean, keep your books clean. A lot of people are so excited about making money, they actually forget about the books. Are there any other issues that hit you in the face when you first step in?
I mean, I cannot enforce it enough that the accounting is usually square one. Square one. And I say that because things like on the accounting front, if you don't know a renewal's coming up, your business is going to leak a ton of money. If you don't know what's in your software, your business is going to leak a ton of money. People will just allocate software licenses endlessly because they've got other things going on and the bill increases by 200% year over year. So I cannot stress enough that the accounting actually drives a lot of the influence. And part of that too is saying things like, I don't need to track the bottled water in my business. I don't need to track the repairs versus cleaning that's going on in my business. What I need to track is big thematic things. It's just like anyone opening up their own bank account. Usually people get scared because they go, I see lots of transactions and they're all in different things. Helping organize that in a clean manner to say, here's what you're spending on food and entertainment. Here's what you're spending on your house. Here's what you're spending here. Those things drive a lot of how your mental model works for the future. Now, I will say there's a lot of pain points like after the accounting is squared away and fixed usually. And a lot of founders, the next one tends to be financial planning for the next 12 to 24 months to say, do I have 6 months of cash after I've just hired all these people? Or do I have 24? I don't know. We see that a lot in our work. It's usually the next biggest problem.
I've got a question for you. You work with startups, you work with companies that have certain needs at certain times. I talk to a lot of M&A guys and a lot of exit strategists. Do you ever get involved with someone with a business when they say, look, I want to exit. I'm not sure my setup is tidy enough. I'm not even sure I'm ready to exit on paper, although I want to exit. Do they ever bring you in to help with that?
Yeah. In fact, we're on one of those right now.
Right.
And why would they bring us in? You know, it's funny, Gary, is we helped on multiple angles with their exit. So they have financials, good business, solid growth. But one of the things they didn't quite understand is what are our metrics? Like we know what we know, we don't know what we don't know. Can y'all help us get organized to say, what are the pain points we need to solve? What is the data we need? And then unraveling all of that and knowing exactly where a potential buyer will come in. On top of it, you'll have a lot of flashy stakeholders that come in and say, we can partner with you to sell this thing. And so what we've done is run bake-offs for clients. And not just once, but multiple times. So we've been in multiple private equity and strategic back exits, where let's do a bake-off, or if you've got a set of investors you want to run, we can help with that. Getting the data room set up on all the inputs and everything. And there's a lot of value that other stakeholders will have outside of what Finity does. They've got the relationships, they've got the scale to run a process, but knowing how certain technical accounting implications will flow into the P&L, so that way when the buyer sees it, they're opening up clean data, and that you can present your story in the best light, that's where we thrive.
That maximizes, obviously, the value.
We've seen a few clients where their multiples have gone up by 1, 2, or 3 times because of the cleanliness, the organization. What a lot of buyers will do and investors will say, you aren't organized. I don't believe your data because you don't know your data. So I need a lower valuation to manage my risk of your business. In fact, one advisory relationship I had for a private equity was they started lowering the value because the prospective buyer or the client they were buying didn't know how many customers they had. To say you don't know how many customers you have, it's squishes about this many to this many. It's important to walk into a room, know that number, and then when they get the data room, they have that information. That's important to do.
So moving on to technology now, obviously, they didn't have a CRM system, they didn't have anything. How much are you using technology or bringing in technology into the plan and the key metrics, etc.?
Day one. Day one. If we can, day one. Sharing data is always kind of tricky, but what I would say is that's one of the reasons we offer a dashboard in our services. It's not required. It's just something we do. And why? Is because having everything manually compiled isn't a scalable thing. Having it in a tool that's integrated and runs is much more useful to clients. And then having something that, one of the things we often see is I'm in HubSpot or I've got Salesforce or potentially even both. And then I've got my P&L in QuickBooks. I don't understand it, but it's good enough. And then I need to know my cash and how do I even calculate my annual recurring revenue or my recognized revenue? I don't know. What we've done with a few is pull it all together. So it's a single pane to say, here are your meetings. Here's your pipeline. Here's your metrics. Here's your profit and loss statement, your cash. And in my opinion, that is one phase of it. And you talk about how do you set up the technology and all that. The other thing that we really, really, really emphasize is the use of automation. So there's a lot of things available that people just don't know about. And not only that, there's the automation, but also knowing how to set it up to report on. So there's a lot of great capabilities within a lot of these ERPs and accounting softwares that will let you have that visibility so long as you know how to do it. But if you don't, no one really trains you up on it. You just kind of have to know, which makes it very hard.
I think the beauty of what you're doing is you're doing a process. You're working with people that haven't taken you on to do automation or bring in technology. You're actually doing an overall job, and as a side event, you're bringing in technology. What I find, without boring you to death, is that when I talk to business owners and people about technology, they say, well, I use OpenClaw, I've got Claude, I've got ChatGPT. When I try to explain to them, well, you can put together a system with a dashboard and all these things that will actually make your life easier, cut down manual hours, increase your visibility, etc., they don't quite understand the difference between a system and AI tools. I think you have found the best entry route because you're actually not talking about that. It's just an end result.
I think for us, what I really am passionate about is the automation and the integration. I think the AI stuff is super helpful to have in tandem. It's a great tool in your toolbox. It's one of the things I use a lot. At the end of the day, though, from a visitability standpoint, what we find with buyers is, and investors too, how many headcount do you have in that plan? What are you planning to spend on that month? Why is that number so high? You can't just blanketly trust things. You need to go and verify and validate and all of that. A great accounting example is that the accounting classification for payroll, the accounting classification for equity, each one of those has a different accounting means that you need to know based on the interpretation of US GAAP, based on the underlying contract, and pulling all of that together. And my hope is that those tools can guide you and lead you, but at the end of the day, certain triggers and words and all of that, they all differ based on what a person.
So you don't think AI or AI is going to replace people in finance? I mean, a lot of people think in the UK think, AI will replace the need for an ordinary day-to-day accountant. Maybe not a business advisor, but a day-to-day accountant, because a lot of the stuff in the UK is form filling and just putting in tax returns and, ticking boxes. Is that worry? Is that a worry in the States? Do we see AI as a threat or as a help?
I see it as a help, and I see it as, to lend from a comic book analogy. It's an Iron Man suit around people. It supercharges people. That's how I see it. And why I feel that way is, for any finance professional who has been through audit, you know that there's a lot of subjectivity in contract review work. And you have to go in and check everything. And that's where AI may be a great tool, but it is not the solution to everything. For anyone who's done tax prep work in the States, things like a big mouth Billy Bass fish on your wall is a furniture and fixture, or is it, some sort of office equipment? And is it maker's depreciation or straight line depreciation? It's just those little nuances that I think AI can guide you down the right path. And a great AI gives you the thought process. But it takes sometimes folks to say whether that is right or not based on a long history of experience and knowledge.
You need the experience. Tell me, when you go in and do a job, obviously finance, you do the books, you do a lot of stuff. How do you show an ROI? And is it important to show an ROI as opposed to just getting the systems and the job done as such?
In my opinion, that's what we do. And what I usually say to folks, what we do is it starts up at lead to cash. And what that means is, if I take $1 in, how many leads, what opportunities, what pipeline is generated, close won deals, revenue, income, and then cash in the door. Understanding that is not an easy feat. And that's the ROI, and measuring that ROI is what we thrive.
Cool. Just before we start to wrap up, in your experience, what separates businesses that scale cleanly as opposed to those that constantly struggle?
Great question. I think the ones that scale very well are having great external parties that they know they can trust and lean on. And it may be like a funny answer, but what I really believe is the businesses that scale, even small scale, but great exits, or scale repeatably to that hyper growth phase, is when they have a great team around them, and that either a CEO and their CFO, or a CFO and their VP, or the VP and their director knows that they can inherently trust them to do what they need to do. That is a great team. and a team
So
that,
you promote delegation.
oh, 100%. I mean, you can't do it all by yourself. Can't do it all by yourself. And I'll give a fun little analogy is we were fortunate enough to hire someone to help us design our house. My wife and I have tried to design our own house, like, put the little furnitures, fixtures, design choices, all that. And she did such a better job than we ever could. Ever could. And I'm a firm believer that if you have an expert that you can know and trust, that's much better than trying to do it all yourself and trying to fumble around and figure it out.
Makes sense. So if you could, if you had a wish and you could make one change across every growing business tomorrow, something that would materially improve outcomes, what would that one wish be?
My one wish would be systematize. Get it in a tool. Don't do it manually. Try and get integrations built. Do it in things. Don't try and manually do it because it's going to break. It often does.
All right, that's great, Tim. Look, I've really enjoyed this. You said it wouldn't take an hour, but we've been here 53 minutes. Maybe I just asked too many questions. But for founders listening in and guys who need your service, what's the first practical step they should take after this conversation? And where should they contact you and how do they go about taking you on?
Yeah, I go to our website, finitynow.com, fill out the form. We'll reach out, connect. I think my email's out there. We're always we're excited to talk to new founders. It starts off with a conversation. Trust isn't given, it's earned. So starts with just talking, hearing what we have to say, engaging a few months, seeing if there's value or not. That's really how it all starts. And then we like to do, evaluations, scope out work. And there's definitely been times where we said, we can't provide value. You should go elsewhere. And so we're happy to have that conversation and teach people what we know and see if there is a partnership there.
Tim, I've got to tell you, this has been a really good conversation, very sharp and very practical. And to everybody listening, if you're scaling a business, this is the man you want to talk to. I'm Gary Wayne. This is Wise Tech for Wise Money. We've enjoyed talking to Tim today. Thank you very much for joining us as a guest. And we look forward to hosting another Wise Tech for Wise Money in the near future. Thank you, everybody. Have a good evening, good afternoon.
Thanks, Gary.
Thank you, Tim.
Bye.